So for today's lecture, we'll be moving on to the next topic, which is international parity conditions. So the first international parity condition that we talk about is the relation between your exchange rate and your interest rates, okay? So that's the most important parity conditions. So when we say parity conditions, that means we're talking about, excuse me, a relationship, okay? So how is interest rate, for example, how is interest rate related to foreign exchange rates, okay? So the outline for today is we will first introduce the interest rate parity condition. So as we mentioned before, we are linking the interest rate to the foreign exchange rate, okay? So we are going to prove the, we are going to derive the interest rate parity condition first. And then we are going to use arbitrage to prove that this condition should hold, okay? So just a bit of theoretical background. Now, in terms of financial pricing, right? So when we talk about pricing a financial asset, so in the theory, there are two ways you can price a certain asset. So you could either look at the cost. So for example, if I build like a bicycle, I need to buy the wheels, I need to buy the handle, I need to buy the frame, so on and so forth. So if I can, if I know the cost of each of the elements to the bicycle, I can work out a price or a fair value of the bicycle, right? In a second method to work out a price of an asset is to look at under which condition the asset value would hold, okay? So for example, with our arbitrage calculation that we just did in today's tutorial and yesterday's tutorial, we look at how, we look at why the exchange rate between the euro and the franc should be the same as the cross rate, okay? And through that exercise, we were basically using the arbitrage strategy to prove that that condition should hold, okay? So in this particular lecture, we're going to be using arbitrage pricing to prove interest rate parity condition, okay? We also talk about different types of arbitrage when we have interest rates. So here we will talk about covered and uncovered arbitrage, okay? So when you see the word covered, that means we are, our strategy involves the forward contract, okay? When it's uncovered, that means we are using just the spot market, okay, at different points in time. So from the interest rate parity condition, we will then look at how to use it to forecast exchange rates, okay? And finally, we look at the real life example where sometimes you don't see interest rate parity conditions hold, and we look at reasons why, okay? So interest rate parity is derived by an arbitrage calculation, okay? So with interest rate parity, this is a non-arbitrage condition. So when the interest rate parity holds, that means there's no arbitrage opportunity for us to take advantage of. Now, when we look into the data, normally we don't see any persistent arbitrage profits, and therefore this allows us to empirically say that the IRP or the interest rate parity in general, most of the time it holds, okay? So when we say interest rate parity, we are talking about the relationship between interest rate and exchange rates, okay? So here on this slide, we're trying to derive that condition, okay? So here, suppose that we are a US investor. So we are a US citizen, okay? And we are looking at two different investment options. Let's say we have $1 to invest, okay? So we start with $1. Now, with option one, I could invest in the US. I could invest in my home country, and I will earn the interest rate in that country, okay? So in this case, what I'll do is that I'm going to take my money. I'm going to buy a US Treasury bond for a year, okay? So if I do so throughout the year, I would be earning the interest rate prevailing in the US market, okay? So if I invest for 1 year, so this is me today, and this is 1 year, okay? If I invest in the US for 1 year, and if I earn an interest of IS, which is the interest rate in the US, so by the end of the year, my investment should grow to the principal amount, which is the present value, times the future value factor, okay, times the compounding factor, okay. So in the end of the year, I would get back my principal, which is $1, and I will earn an interest of I%, okay, IS%, so that in the end, after 1 year, my investment outcome would be $1 times 1 plus the interest rate in the US, okay. So here with my domestic investment, after 1 year, I have earned this much, okay. Now, an alternative is I could be looking at, say, a foreign market, okay. So in this case, suppose that I can choose a foreign market to invest. So I'm going to pick the UK. So my second option here is I'm going to invest in the UK, okay. Now let's look at this investor who wants to invest in the UK. If I want to invest in the UK, I would need to first exchange my US dollars to the pounds, okay? So I started with $1 before. So the first step I'm going to do if I want to invest in the UK is to exchange this $1 to the pounds, okay? Now, given that the spot exchange rate between the dollar and the pounds, so here I've got the dollar over the pounds, okay? So this spot exchange rate is the price of the pound in terms of the USD, okay? So if I invest if I convert $1 into the pounds at the current spot rate of S, I should get 1 divided by S pounds, okay? So this is the amount of pounds I would expect to get if I convert the dollar into the pounds today, okay? So this is how much pounds I would get if I convert $1 to the pounds, okay? So once I get the pounds, I'm going to use that money to invest in the UK. And because I'm investing in the UK, I will be earning the interest rate in the UK, okay? So here I started with this much at time 0. I will invest in the UK and I'm going to earn the interest rate in the UK for a horizon of 1 year, okay? So by the end of the year, I should expect to get this much, okay? So I invested this much at the start of the year. By the end of the year, I should get the future value of this, okay? So one point to note is that because I invested in the UK, I should earn the pounds, okay? So this should be a pound proceed. Now, because I'm a US investor, I'm going to have to convert these pounds back into the USD eventually. So what I'm going to do next is that I'm going to convert these proceeds from the second step back into the USD using currency forward, okay? So here at the current time, when I look forward, I expect to earn. When I look forward for a year, I expect to earn this much after a year, right? And this is pounds. So if I want to eliminate any exchange rate risk exposure here, at time 0, I'm going to enter into a forward contract to hedge this position, okay? So here in this case, I'm expecting to receive the pounds, okay, after 1 year. So in this case, if I want to hedge my currency exposure, do I want to enter into a long forward or do I want to enter into a short forward? In other words, do I want to sell the pounds forward or do I want to buy the pounds forward? So in this case, because I'm expecting to receive money, okay, so I'm expecting to receive the foreign currency. So to hedge this transaction, I will be selling the pounds forward, okay. So how much do I sell the pounds? How many pounds do I sell? I will be selling an equivalent amount of FV2, okay, because this is what I expect to get after 1 year of investment, okay. So in the current time, I'm going to be entering into a short forward position to eliminate any exchange rate risk for this amount of pounds, okay, which I expect to get from my investment in the UK after 1 year. So if I sell the pounds forward at this forward rate, so this is the price of the pounds in the USD for a 1 year forward contract, okay. So if I have the pounds, so this is my pounds. If I want to compute the US equivalent after this forward transaction, I'm going to times it by the USD divided by the pounds, okay? And this is a forward transaction, so I'm going to write F here, okay? So after this step, I see that with my UK investment, after I convert it back into the USD, I will get this much in USD, okay? So with the second option, my outcome would be my final outcome would be this much, okay? So here what I did was I just replace FV2 with this bit, okay? And that will give me this final product, okay? So I'm going to explain to you why in the second investment option, we have to go through these many steps, okay? So with the second option, now the first step was to convert the dollar into the pounds, okay? This is quite straightforward, right? If we want to invest in the UK, we need to use the pounds. In the second step, this is my expected investment return, which is just the future value of how much I invested today, okay? This is quite straightforward as well. Now, in the third step, what I did here was that essentially I'm saying that I know that I'm going to receive the pounds in the future, and I want to eliminate any exchange rate risk exposure, okay? So here I'm going to just lock in my US proceeds for my pound investment, okay, upfront. So through this step, I just eliminated all exchange rate risk exposure for my UK investment, okay? So that this outcome here is a certain outcome, okay? Which means that this is a known outcome for us at the current time, okay? So if we compare these two investments here, so this investment is a domestic investment, so we just invested in the US, okay? Now this investment has no foreign exchange rate risk because this is our home currency, okay? This investment has zero credit risk because we are investing in the risk-free rate. So IS here is the risk-free rate in the US, okay? So credit risk is zero. The time horizon is 1 year. With the second investment, now as we mentioned before, after step 3, we essentially remove any foreign exchange rate risk, right? So that for the second investment, my foreign exchange rate risk is also 0. Let's look at the credit risk, okay? So in this case, I'm investing in the risk-free rate in England. So IPOW here is it should be IUK. So this is the risk-free rate in England. So in terms of credit risk, this should be 0 as well, okay? So here I'm assuming that both countries are very safe. So credit risk is virtually 0, okay? Because I'm investing in the government bonds. Now with the second investment, the time horizon is also 1 year. So if you look at the risk profiles of the two investment options I have on this slide, they look exactly the same, okay? So essentially, they have the same risk profiles, they've got the same investment horizon, and therefore, these investments should have the same value, okay? So if your investment has the same risk as the market, for example, it should be priced at the market, okay? So given that these investments have the same risk profiles, I'm going to argue that the investment returns for both of these options should be the same as well, okay? Which means that outcome one, which is on my left-hand side, should be equal to outcome two, okay? So we have just walked through, we have just proven the interest rate parity condition, okay? So this is interest rate parity condition for you, and we have just proven it, okay? So here, we have derived the interest rate parity condition. So in this case, the interest rate parity condition says that the interest rate in our domestic market, the domestic economy, should be equivalent to the interest rate in the foreign country after we adjust for the differences in the exchange rates, okay? So in other words, whatever I earned, how much money I earn when I invest in the domestic country should be the same as how much money I would earn if I invest in the foreign country after I adjust for the differences in the currencies, okay? So in the next slide, we'll look at how to prove the interest rate parity condition using arbitrage, okay? So what we're seeing here is that we are saying that this condition has to hold. So this equation has to hold, otherwise arbitrage would happen, okay? So for example, suppose that the left-hand side of the equation is less than the right-hand side of the equation, okay? So in this case, if we go back to our investment options before, in this case, what happens is I will earn less if I invest in the US, and I will earn more if I invest in the UK, okay? So in this case, if the parity condition doesn't hold, there is an opportunity for arbitrage, okay? So how do we arbitrage in this case? When we have interest rates, right? When we arbitrage using interest rate, we are talking about borrowing money at a low rate, and we are going to be lending money at a high rate, okay? So with arbitrage conditions, this is when we identify mispricing and we are going to take advantage of that, okay? In this case, the government bonds in the two countries seem to be trading at two different prices. And what I'm going to do is I'm going to be borrowing and lending in two different countries to take advantage of that mispricing, okay? So here, because the left-hand side is lower, I'm going to be borrowing here, and I'm going to be lending to the right-hand side, okay? So I'm going to be borrowing in the US, and then I'm going to convert the money into pounds, and then I'm going to invest in the UK using the pounds, okay? So to hedge my foreign exchange rate risk, I once again involve the use of the forward rate, okay? So here I'm going to use the forward rate as well. So this strategy is called covered arbitrage, meaning that our position is covered by the forward contract, okay? So that all the numbers that we talk about here is known as of today, okay? So to conduct this arbitrage strategy, these are the transactions that we need to do. And this is summarized on the slide here, okay? So here I'm going to be borrowing in the US. And if I borrow at time 0, I will be receiving the money from my lender. But in the future, I'm going to be paying my lender, okay? So I'm going to be paying the future value of what I borrow at the start. And therefore, this will be a cash outflow for me in the future, okay? In step 2, I'm going to be lending in the UK, where the interest rate is a bit higher. So if we think about lending in terms of cash flow, so at time 0, when I lend money to people, I need to give them money. So this is a negative cash flow, okay? In contrast, when the loan matures, say after 1 year, I expect to receive money back from my borrowers. And therefore, in this case, I expect to receive a positive cash flow, okay? Finally, I'm going to involve I'm going to sell the proceeds. I'm going to sell the UK, the power proceeds forward so that I can lock in a US return as of today, okay? So this is the return, this is a payoff from my forward function. So overall, if I want to compute the overall cash flow of this strategy, at time 0, I will add up all these columns and it will add up to 0. That means at the current time, we are not out of pocket anything, okay? At time 1, this is when the contract matures. This will be my payoff, okay? So if I add up all these numbers, I will get this payoff, okay? So you don't need to memorize these slides at all. What I need you to do is I just need you to understand how to conduct this arbitrage problem, okay? So let's go through a numerical example to see if we understand what we are doing here, okay? So for example, let's look at example 6.1 in your textbook. Now, in this case, I've got 2 countries. I've got the US and I've got the UK, right? Similar to our example before. The interest rate in the US is 5% per annum. The interest rate in the UK is 8%, okay? So when we say interest rates here, in economics, okay? So when we say interest rate in a certain country, we're talking about the risk-free rate, okay? Or the government rate. So in the UK, the interest rate is 8%. Currently, the foreign exchange spot rate and the 1-year forward rates are 1.8 and 1.78, okay? So the spot rate is 1.8 USD per pound. And the forward rate for a 1-year contract is 1.78, okay? USD per pound. Assuming that we can start with either 1 million US dollars or the pound equivalent, which is 555,556, okay? So the question asks us to determine whether there is an arbitrage opportunity and show how this arbitrage profit can be achieved, okay? So I'm just going to summarize the question here. So our risk-free rate in the US is 5%. Our risk-free rate in the UK is 8. Our spot rate, so this is the price of the pounds in terms of the USD, is 1.8. Our forward rate is 1.78, okay? So if I go back to my interest rate parity condition, This is my interest rate parity condition, okay? So one point to note here is that on the left-hand side, say I've got the interest rate for the domestic country, okay? So this is domestic interest rate. And then on my right-hand side, this should be a foreign interest rate. So if this is the case, if the domestic rate is on the left-hand side, then with the forward and the spot exchange rates, this should be the price of the foreign currency in the domestic currency, okay? So this should be domestic over foreign, okay? So that's something to note. Okay, so in this case, for the questions I have here on the slide, if I check the interest rate parity condition, on the left-hand side, it's equal to 1.05, okay? So 1 plus interest rate in the US is 1.05, okay? On the right-hand side, if I calculate these terms, I will find that it will be equal to 1.068, okay? So in this case, borrowing in the domestic country is cheaper than borrowing in the foreign country, okay? In contrast, lending in the domestic country does not yield as high as lending in the foreign country, okay? Also, for these questions, we are going to assume that borrowers and lenders can lend and borrow at the same time, at the same rate in each of the countries, okay? So here, because borrowing in the US is cheaper, we are going to borrow in the US. At the same time, we are going to lend in the UK because we get a higher investment return, okay? Okay, so let's work through this problem together. Okay. So as we said before on the previous slide, we are going to be borrowing in the US and we are going to be lending in the UK, okay? So to conduct this arbitrage strategy, therefore, I'm going to do these steps, okay? I'm going to do the following. So here I'm going to start with 1 million USD, okay, as per the question. So what I'm going to do is I'm going to construct this table over here. So on the first column, I'm going to describe my transactions. In the second column, these are the transactions I need to do in time 0. And in the third column, I describe the transactions that happened in time 1, okay, which is 1 year after. Okay. So here I'm going to start with 1 million USD, okay, which is here. Now, as we said before, we were going to borrow the USD at 5%. So we are going to borrow the US dollars at the start, okay? So how much do we borrow? As we mentioned before, we'll be borrowing at 1 billion USD, okay? So because we are borrowing here, at time 0, when we take out the loan, we will get the money, okay? So the lender gives us the money, and therefore this is a positive cash flow for us. In the second step, I'm going to convert this USD. Hang on one second, I've got someone in the chat screen. Okay, thanks, Phong. So in the second step, I'm going to convert this USD into the pound at the current spot rate so that I can invest in the UK, okay? So in the second step, I'm just converting the dollars, so $1 million into the pounds so that I can convert, I can invest in the UK. So for 1 million USD, if I convert it into the pounds at 1.8 USD per pounds, I will get, 1 second, I'm just going to check the chat screen. Okay, thanks, Phong. I have seen that. So if I convert 1 million USD into pounds at 1.8 USD per pound, I will get 555,556 pounds. Okay. So in this transaction, essentially, I'm selling the USD to acquire the pounds. Okay. So after the second transaction, I should be having 555,000 something pounds for investment. Okay. So in the third step, I'm going to invest the pounds in the UK to earn the UK interest rates, which is 8%. So I'm going to go to the UK and buy a government bond for a year. So when I invest in the UK, so when I buy the bonds, when I buy the UK government bonds, I need to pay, right? And therefore, I'm going to pay. So this is a negative cash flow, okay? So these are all the transactions I will be doing at the start, which is today. Now let's look at what happens in 1 year's time, okay? So I have set up all my transactions at the start. Now what will happen in 1 year's time? So in 1 year's time, with the first transaction, this is when I borrow the USD, okay? So if I borrow it for a year, in 1 year's time, this loan matures and I need to pay back my my lenders, okay, in the USD. So in this case, how much do I pay back? If I borrow $1 million USD at the start for a year, I will need to pay the future value of this 1 billion, okay? At the current interest rate of 5% in the US, this will be equivalent to 1.05 million USD, okay? So in the future, in 1 year's time, I will need to pay this much to my lenders in the US. On the other side of the globe, let's look at my investment in the UK, okay? So remember at the start, we have invested in the UK government bonds at 8%, okay? So after 1 year, this investment matures and we expect to get the future value of that, okay, at the UK investment rate of 8%. So if I invested 555,000 pounds at the start, and if the interest rate is about 8%, I would expect to get back this much, right? So 555,000 times 1.08, and that would be 600,000 pounds, okay? So what else do I need to do? Now I can't just compare these two transactions directly because they are in two different currencies, okay? So there is one extra step that I need to do, which is to convert the pound investment returned in this step back into the USD, okay? All right, so in the last step, what I wanted to do next is to convert the pounds that I earned from this investment back into the USD. Now, if I want to eliminate all of the foreign exchange rate risk, I will be converting this amount back into the USD using the forward contract, right? So at time 0, I will be entering into a forward contract to sell the pounds at the forward rate of 1.78, okay? How much do I sell? I'll be selling the future value from step 3, okay? So in the current time, I will need to sell the pounds forward using a forward contract for a size of 600,000 pounds, okay? So after a year, I'm going to deliver this forward contract. So I'm going to be selling 600,000 pounds for the USD at this rate, which is 1.78. Okay. So how much USD do I get? I will take 600,000 pounds. I will times the value of each pound in terms of the USD, and I will get 1,068,068. Okay, USD. Okay, so after this step, if I want to calculate my arbitrage profit, I would take how much USD I got from the fourth step. I will minus it with the USD liability that I saw from the first step. Remember from the first step here, when we started, we said that in the future, in 1 year's time, we need to pay our we need to pay our lenders the future value, okay? So this is how much we need to pay, 1.05, okay, for my loan. So as a result, my investment return would be, my arbitrage profit would be the difference between this number here and how much I need to pay my lender, okay? So that will be the difference between 1.068 and 1.05, okay? So overall, I have earned about 18,000 USD, okay? So if I want to check, my strategy to see if I've done it correctly or not. So here, if I look at the transactions at time 0, now remember that we are doing an arbitrage transaction, okay? Arbitrage strategy, okay? So with arbitrage strategy, by definition, at time 0, the transactions should finance themselves, and therefore we should not out of pocket anything, okay? So let's check time 0. In time 0, here I'm highlighting the transactions in the USD in orange, okay? So we started with 1 million USD in step 1. In step 2, we have converted it into the UK, into the pounds, okay? So after step 1, we have a net 0 in the USD. Now from step 2 to step 3, from step 2, we have acquired some pounds, but in step 3, we have used that pound to invest, okay? So after step 3, our position in the pound is also 0, okay? So these transactions, they finance themselves, and therefore at time 0, I am not out of pocket anything, okay? In contrast with the transactions in time T1, now if I check my USD position, okay, so if I add up these two numbers, this is the profit that I got in the end, okay? So this profit is in the USD. If I check my UK position, if I check my pound position, in step 3, I've got a positive number in the pounds of 600,000. In step 4, I have converted it into the USD, okay? So in step 3 and step 4 will offset each other, and my pound position in time 1 would also be 0, okay? So overall, we have not had any exposure in foreign exchange rates, and we have a positive profit in the end, okay? This is what we want for an arbitrage strategy. All right, so we have walked through how to construct an arbitrage strategy for interest rate parity conditions, right? So what we said was we wanted to borrow cheap and we wanted to lend high, okay? So we wanted to lend expensive. So in this case, the US was the cheaper market, so we borrow here, and then we went to the UK to invest, okay? Overall, we find that we are not exposed to any foreign exchange rate risk. We are not out of pocket anything. and yet we still end up with a positive profit. Okay, this profit is from the discrepancy between the interest rates in the two different countries. Okay. One more thing to note is that with covered arbitrage, because we have locked in our exchange rate in the future using the forward rate, these transactions, the value of this transaction should be known to us by today. Okay, so this number should be known to us as of today. Okay, this is why it's called covered. It's because our we are not exposed to any foreign exchange rate risk. Okay, we have covered our position. Okay, so in the next step, I'm just going to rewrite the interest rate parity condition, and in this case, I'm going to show you two different ways to write the interest rate parity condition. Okay. So in the first case, this is my domestic country. So for domestic, I'm gonna write D. So on the left-hand side, I've got the interest rate in the domestic country. On the right-hand side, I've got the interest rate in the foreign country. Okay. If I write my exchange rate like this, then the forward and the spot rates here should be domestic divided by foreign. Okay. If foreign is on the left, it should be on the left for the exchange rate as well. Sorry, if domestic is on the left, then domestic should be the left-hand side currency as well. Similarly, if foreign interest rate is on the right, then the foreign currency should be on the right as well. Okay, so this is one way to remember. In contrast, if I want to write this equation in terms of the value of the domestic currency, I can take the reciprocal of this rate. Okay. So in this case, if I take the reciprocal, I'll be looking at the exchange rate between the foreign currency and the domestic currency. Okay. So in this case, I'm looking at the price of the domestic currency in the foreign currency. Okay. So for ease of understanding, I would just normally stick to the first one. Okay. So it's up to you, but normally I will stick to the first one because I can remember the order of the interest rate and the exchange rate. Okay. So if I rearrange this equation, so if I bring the forward rate to the left and I bring everything else to the right, then I will get this equation here. Okay. So this equation allows us to calculate the forward rate using the relative interest rates in two different countries and also the current spot rate. Okay. All right, so we have gone through an example together before. In this example, let's look at a similar problem and let's see if we can solve the problem by ourselves, okay? So in this example, we have a treasurer of IBM and we have some cash reserves, right? So we have some money to invest and we're thinking about where to invest for 6 months, okay? So the principal amount that I have is 100 million USD and I want to invest for 6 months, okay? I'm looking at two different investment options. So if I invest in my home country, which is the US, I can get 8% per year. So if my interest rate is 8% per year, that means for 6 months, I will get 4%, okay? You need to be careful here with the time horizon. Normally, the interest rate is quoted on a per annum basis, but sometimes our investment horizon is a bit different, okay? In this case, the investment horizon is 6 months, so I will take half of the interest rate. Okay. My second option is to invest in Germany, and if that's the case, I will be looking at 7%. Okay. So for a 6-month investment, therefore, it should be 3.5. Okay. We also given information about the spot and the forward exchange rate. So at the current time, the spot rate is 1.01 euro per USD. Okay. So be careful with the exchange rate here. This is the value of the USD in terms of the euro. Okay. Now the 6-month forward rate is 0.99 euro per USD. So here my forward rate is going to be 0.99 euro per USD. Okay. Now, we also don't want to bear any exchange rate risk. That means we have to involve the forward contract to eliminate any future exchange rate movements. Okay. So in this question, the question here is which country do I invest? Okay. So where should I invest to maximize my returns? This is similar to the first problem that we look at the start when we derive the interest rate parity condition. Okay, remember when we look at two investment options in the domestic country and in the foreign country, right? So let's use that example and see whether we can solve this problem by following the same procedure. Okay. So in this case, let's spend about 1 or 2 minutes to think about this problem. And when we come back, we will talk about the answer, okay? So here, as we mentioned before, we're looking at two options. The first one is the US, and the second one is the Germany market, okay? We want to invest, so you want to look at the investment returns for the 6 months horizon, okay? So here, I want to look at the investment return. For both options for a 6 months horizon, okay? So compute the investment returns for both options for me. Also think about how to eliminate exchange rate risk, okay, when you invest overseas, okay? So in your answer, you should have two different options. You should have a domestic investment option, and then you should have a Germany, okay, or a foreign country investment option, okay? So 2 minutes. When we come back, we will talk about the answer, okay? Okay, guys. Now, did you see the whiteboard that I just shared with you with a few notes? Yes, no?
Yeah.
Okay, cool. Thank you so much. So with the whiteboard, can you see the notes I wrote here for the two investment returns?
Yeah, we can see it all.
Okay, thank you. So here I'm looking at two options, right? I could be investing in my domestic country, which is the US in this case. In the second option, I'll be investing in Germany, okay? So my task here is I want to see which one would yield me a higher investment return, okay? So on the left-hand side, I'm looking at the US investment. Now, if I invest $100 million at the start, and if I invest it for 6 months and the interest rate for 6 months is 4%, how much do I get at the end? After 6 months, how much do I expect to get? Yep, I've got an answer in the chat box. 104 million, yes, spot on, okay. So here I'm just doing a future value calculation, right? I'm just going to take the principal, which is 100 million USD, and I'm going to times it with 1 plus R or I, 1 plus I, let's just say I. In this case, it will be 100 mil times 1.04, and that will be 104 million, okay, USD. Okay, I'm just going to highlight the currency here so we know we're talking about the domestic currency. So in the first option, we do not need to worry about exchange rate exposure because we're dealing in the home currency. Okay. With the second option, I've got an option to also invest overseas and then convert my investment return back into the domestic currency. Okay. So in this case, I'm thinking about investing in Germany. Now, if I want to invest overseas, the first step is I need to convert my USD into the euro, okay, at the current spot rate. So currently, let me just look back at the spot rate. So currently the spot rate is, how much is it? So 1.01 euro per US dollars, okay? So if I have 100 million USD, how much can I get in terms of the euro? If I convert it into the euro, what would be the equivalent euro amount? Okay, so if I want to find the equivalent euro amount, it will be 101 million euro. Okay. So after I have converted my USD into the euro, I'll go to take that money to invest in the government bond. Okay, I'm going to buy a government bond now, and I'm going to hold it for 6 months. Okay, at the current interest rate of 3.5% per 6 months, I expect to get, if I invest 101 million euro at 3.5%, how much do I expect to get after 6 months? Guys, do some calculation for me here. Yep, I've got an answer here. 104.535. Okay, yep, that's correct. Thanks, Kang. Excellent. So here I'm just calculating the future value again. So I'm going to take 110. I'm going to times it with 1.035, okay, which is 1 plus the interest rate in the UK, sorry, in Germany. So if I did that, I will find that this will be 104 million and 535,000 euro, okay. So I know that I'm going to earn a euro amount after 6 months, but because I'm a US investor, I'm going to have to convert this back into the USD eventually. Now, we also don't want to bear any foreign exchange rate risk, yeah? So at the current time, instead of having to wait until 6 months and transact the USD and exchange the euro back into the USD at the future spot rate, what I can do is that at the current time, I'm just going to enter into a forward contract, okay, for the amount of 104.535 million euro, okay. So because I expect to get this money in 6 months, I'm going to be selling the euro forward for a 6-month contract, okay. So in step 3, this is when I enter into a forward contract to sell the euro for 6 months. And the amount that I'm going to sell is this much, okay, is what I calculated from step 2. So the forward rate currently is, yep, did someone raise their hand? Do you want to say something? Hi, did you raise your hand? Did you want to talk? Or if you want to talk, just unmute your microphone and talk to me, okay? Otherwise, I'm going to assume that it was by accident and I'm going to move on. Okay, I am going to move on. Okay, so from the question, we know that the forward rate is 0.99, right? Euro per USD, okay? So if I want to convert this much euro, so 104.535 million euro into the USD at the current forward rate, how much do I get? What's the USD equivalent? Yep, I've got some answer here. 105.59 million, okay, USD. Let me check my answer. Yes, exactly, right, spot on. Thanks, Kang. This is the right answer. So here, from this much euro, I'm going to convert back into the USD using the forward contract. So from 104,535,000 euro, I'm going to divide that by the forward rate, okay? And I'm going to get 105,590,909 USD, okay? Oopsie. So by now, this exchange rate calculation should be very familiar to you guys, okay? So we're just applying, we're just converting one currency to the other one, okay? So here, because with the forward rate, I've got the euro divided by the USD rate. So to convert from the euro to the USD, I'm going to take the euro amount, I'm going to divide by that exchange rate, okay? So thanks, Kang. This is the right answer, okay? So what do we do next, guys? We have computed the investment returns for both options. Now, what are we going to advise the treasurer? Am I going to invest domestically or am I going to Germany to invest? Yep, I've got an answer here. Germany, yes, spot on. Thank you so much. I'm going to invest here because I get a higher rate, okay? So here I've got a higher investment return relative to here. So I'm going to go to Germany to invest, okay? All right, so let's go back to our slide. So we have gone through this exercise before and we have found out that the investment return in Germany is higher. So also one thing to note is that for both of the investment options, of course, with the US investment, there is no exchange rate risk. We were investing in the domestic country, okay? For the German investment, there is also no foreign exchange rate risk. Why is that so? Because we have eliminated all the foreign exchange rate risk by using the forward contract in step 3, okay? All right. So to summarize, we have gone through a few exercises regarding the interest rate parity condition, or IRP to be short. Okay. So we started with this equation over here. So 1 plus interest rate in the domestic country is equal to 1 plus. Zihao, did you raise your hand? Did you want to say something?
Yes, I want to ask what is the risk exposure here?
In the previous question?
I want to ask what is the risk exposure here? In the last question.
Okay.
Last problem.
So the risk exposure.
How much is the risk exposure?
Yeah. So the risk exposure here is that we have an investment that is denominated in a foreign currency, right? So this is our investment return after 6 months, okay? Now the risk exposure here is we don't want the euro to depreciate, because if it depreciates, that means when we convert this back into the USD, it will we will receive less USD, okay? Does that make sense?
So all the euro is the.
I'm sorry, I can't hear you very well.
All the euro is the exposure.
I can't hear you very well. Sorry, can you repeat that again? Or maybe use the chat box, okay? All right, so Zihao, I'm going to talk to you a bit later on because I can't hear you. Can you put it in the chat box and I'll check later on? For now, I'm just going to move on, okay? I'm sorry, I can't hear you very well. I think it's the internet problem or something. All right, so we were here. So with the IRP, this was the equation that we derived, right? So on the left-hand side, I have got the interest rate of the domestic country. On the right-hand side, I've got the interest rate for the foreign country times the forward rate of domestic over foreign divided by the spot rate, domestic divided by foreign, okay? So here, if I want to rearrange the equation so that it's expressed in terms of the forward rate, if I rearrange the equation, I will get this one over here, okay? So in this case, another way to check whether we have any arbitrage profit opportunity is to compare the forward rate with what is the fair rate, okay? So in this case, it's similar to calculating the cross rate in our arbitrage problem before. So in this case, with the example that we went through before, example 6.1, I think this is the UK and the US investment problem, okay? Now in this case, if we compute the forward rate between the dollar and the pounds, we will find that the fair rate, let's call the fair rate here, or the non-arbitrage forward rate should be 1.75, okay? Or non-arbitrage. Should be 1.75 based on this equation over here, okay? So every time when the actual forward rate is different from 1.75, this is when the RAP does not hold, and this is when you have an arbitrage opportunity, okay? So if the forward rate is greater than 1.75, in this case, what we want to do is we want to borrow domestic and we want to invest in the foreign country, okay? In contrast, when the actual forward rate is lower than the fair rate, which is the non-arbitrage rate, then we would earn a profit if we lend in the domestic country and we invest in the foreign country, okay? Oopsie, sorry, and we borrow in the foreign country. So lend and invest is the same, okay? When we say lend, it just means investing. Okay, so write this down first, and I'm going to show you why. I'm going to share the note that I had before. Okay, so just make sure that you fill in the blanks here, and we can show you why. Okay. All right, so this is what we are looking at. So here I've got a few notes about this slide. Now, suppose that we are looking at the first case when the actual forward rate is 1.78 and this is higher than the fair rate, okay, or a non-arbitrage exchange rate. So if this is the case, if we put it back in our equation, okay, so if we replace, if we put it back in our equation here, we will see that this will be our equation, okay? So that means the left-hand side is greater than the right-hand side. So if I rearrange this equation into 1 plus interest rate in the domestic country on one side, and then 1 plus interest rate in the foreign country on the other side, I will end up with this, okay? I will end up with this. So, which means that when the forward rate is actually higher than the fair rate, it will be cheaper to borrow domestic, and it will be more expensive to lend in the foreign country. Okay, so in this case, your arbitrage strategy would be borrow in the domestic country and lend in the foreign country. Okay. Okay, guys. Since we are all here, let's just resume our lecture. Okay. So we took a 2 minutes break, not a 5 minutes break as I promised. But I thought if we started early, we can finish early as well. Okay. Okay, so let's go back to our previous example about arbitrage opportunities from IRP. So in this case, if the actual forward rate is higher than the fair rate or the non-arbitrage rate, so let's say it's 1.78, then we have an opportunity to arbitrage. Okay. In this case, it looks like the pound is a bit overvalued. Okay. So recall that with this forward rate, it's the price of the pounds in terms of the USD. Okay. So here, the forward rate for the pound is a little bit too high. And so it looks like the pound is overvalued. Okay. So when the pound is overvalued, you want to invest in the UK. And then you want to borrow in the US. Okay. So this is exactly the same problem as we went through before. So we're just going to recap. Okay. So here I'm going to borrow in the US. In this case, I would just start with 1,000 instead of 1,000,000. After I borrow in the US, I'm going to use the money that I just borrowed, exchange it into the pounds at the current spot rate. Once I get the pounds, I'm going to invest in the UK. Okay. So to hedge any exchange rate risk exposure, I'm going to sell the pounds forward. I'm going to sell the future value of my investment in the in step 3 forward at the current forward rate. Okay. So this number here is the future value of my investment. Okay. So I'm going to sell that forward for the duration of my investment horizon, which is a year in this case. So if we look at time t, which is when the investment matures. Now with the first step, because we borrow here, we will need to pay back our lenders here. Okay. So how much do we pay back? We pay back the future value of $1,000. I'm sorry, this is a typo here. This one should say the USD. Okay, so this one is the USD. With my investment in the UK, after a year, this amount should grow to £600. And then because I have entered into a forward contract at the start, I'm going to sell these pounds forward, essentially converting it back to the USD, okay, at the forward rate of 1.78. So if that's the case, I will find that my USD proceeds will be 1,068, okay? So how much do I earn at the end? At the end, I got this much in US cash inflow. And then at the same time, I got this much in cash outflow, okay? So as a result, my profit would be the difference between that two numbers, these two numbers, and that will be $18, okay? Now, if I check whether I'm out of pocket in time 0, if I add up all of these, I will find that I have a 0 investment in the USD and a 0 investment in the pounds as well, okay? So no out of pocket and a positive profit in the end. Not too bad, right? Okay. In example 2, this is example 2. Now, in this case, I'm going to start with a forward rate that is lower than the non-arbitrage rate, okay? So recall from the previous slide, my non-arbitrage rate is 1.75 and my actual forward rate is actually just 1.7, okay? So as a result, one way to look at this problem is I'm going to say, okay, the pound looks like it's undervalued, okay? So in this case, the pound is undervalued relative to the USD. And so I'm going to be borrowing in the pounds. So I'm going to be borrowing in the UK. And then I'm going to be investing in the USD, okay? So let's look at this strategy here. I'm just going to number the transactions so that it's easier for us to track. All right, so step 1. So once again, I'm going to be borrowing, but in this case, I'll be borrowing the pounds, okay? Because it looks like the pound is undervalued. So here I'm going to be borrowing the pounds at the current exchange rate in the UK. So I'm going to borrow £1,000. And I expect that in 1 year's time, I'll be paying the future value of that, okay? Now, so once I got the money in step 1, I'm going to convert that pounds into the USD and use the USD to invest in the US, okay? So if I converted £1,000 into the USD at the current spot exchange rate of 1.8, I'm going to get 1,800 USD, okay? So step 3, I'm going to get that 1,800. I'm going to invest in the US to earn an investment rate of 5%, okay? So here, if I invest, I will be giving the money to the US government first. So I'll be buying the US government bond. And then I expect to receive the future value of it. Okay, so this is a future value calculation. Also, because I want to hedge my foreign exchange rate risk exposure, I'm going to convert the pounds. I'm going to convert the dollars. Sorry, I'm going to convert the dollars back into the pounds at the end. Okay. So here in step 4, I'm going to convert the dollar proceeds into the pounds at the forward rate of 1.7 USD. Okay. So for this step, I think if you want to convert the pounds here into the USD, it will still end up with a profit number. Okay. So here, if I convert, if I enter into a forward contract to sell the USD for the pounds, I basically eliminate any foreign exchange rate movements here. Okay. So in the third step, when I convert the USD into the pounds, I will get this much. Okay. So in the end, how much profit did I make? So in step 1, I expect to be paying this much in the pounds. So I'll be paying 1,800 pounds. In step 4, I expect to get 1,111 pounds after the conversion in the forward market. Okay. So in the end, I will get a profit of about 31 pounds. Okay. So if I want to check my investment at the start, so once again, if I look at time 0, I will have a 0 position for the pounds, okay? And I'll have a 0 position for the USD as well. Similar here, if I look at step 3 and step 4, I will see that my USD position is 0. Okay. So the only thing that is left for me, therefore, is just the profit at the end. Okay. And this is by definition an arbitrage strategy. All right. So we have gone through a few arbitrage calculations in the IRP, in the interest rate parity condition. Now these exercises show you that whenever there is a discrepancy, so whenever the IRP doesn't hold, arbitrageurs will be arbitraging away the discrepancy, and eventually it should go back to equilibrium. Okay. So with the IRP, we could also write an approximation. Okay. So this is the IRP, and I'm just rearranging it. Okay. So if I rearrange the IRP so that my interest rates are both on the left-hand side and my exchange rate are on the right-hand side, I can write it in an approximation like this, okay? So where does it come from? I'm going to share my note with you guys again. Okay. So in this case, from this equation on the top, right, so from this equation, I'm going to subtract 1 from both sides to get this equation here. So once I subtract 1 from both sides, I'm going to take the common denominator here. So that on the left-hand side, it will become this, okay? So 1 cancel each other out, and I'm left with interest rate in the US minus interest rate in the UK, divided by 1 plus interest rate in the UK, okay? On the right-hand side, I'm going to take the common denominator, and then I will get this ratio here. So F minus S divided by S, okay? Okay, so if we think about interest rates, right? So normally interest rate is about 3, 5, 7%. So it's a very small number, okay? So as a result, because interest rate is a small number, I can say that this is approximately 1, okay? So this approximates to 1. And if that's the case, then this ratio here, F minus S divided by S, should approximate the difference between the interest rate in the domestic country and the interest rate in the foreign country, okay? I'm just going to clear these things. Okay. So if I plot, so given that we have this approximation here, so the differences in the interest rate, the difference in the interest rate in two countries, between the domestic country and the foreign country, should be approximately the same as the difference between the forward rate and the spot rate, okay? This is what this equation is about. So in that case, if I want to illustrate the relationship between interest rates, change in interest rate, and the change in the spot rate, then I can draw this graph over here, okay? So if I illustrate the IRP on a line, it will look like this. This should be a 45-degree straight line. So on the vertical axis, I'm looking at the difference between the two interest rates, so domestic minus foreign. On the horizontal axis, I'm looking at the differences between the forward rate and the spot rate, okay? So whenever you're on the line, this is when the change in when the difference in the interest rate is approximately the same as the difference in the forward and the spot rate. Whenever you are outside of the line, this is when the interest rate parity does not hold. Okay, so this is when the difference in the interest rate is quite different from the difference in the exchange rate. Okay, so in these cases, the IRP does not hold. So for example, if we look at this point here, which is A, okay, so for A, on the vertical axis, it will be minus 3%, okay? So the difference in the interest rate for A is minus 3%. Whereas the differences in the exchange rates for A is only minus 1 something, okay? So in this case, it looks like A is not, it looks like the IRP does not hold, okay? So when the interest rate is higher than the exchange rate, sorry, when the interest rate is lower than the exchange rate, in this case, I'm just going to write it here like this. So if we rearrange the equation, we will find that in this case, it looks like the pound is overvalued relative to the USD, and therefore one way to arbitrage in this case is for us to borrow in the US and lend to the UK. Okay. So through this arbitrage, what do we think will happen to interest rates? When a lot of people borrow in the US, what will happen to the interest rate in the US? The interest rate in the US would increase, okay? At the same time, if a lot of people lend in the UK, there will be oversupply of lending, and so the interest rate in the UK would decrease, okay? And that will bring A towards the right. At the same time, if we think about the effect on the exchange rates, now when people arbitrage in this case, when they borrow in the US and they lend in the UK, what do they do with the exchange rates? They'll be selling the exchange rate, okay? So if we go back to our example before, we will see that when this happens, we'll be selling the pounds forward, okay? So when we sell the pounds, we put additional pressure on the pounds in the forward market, and that will cause a depreciation of the pound, okay? So A will move down here as well. So the average effect of these two forces is that A will move along this dashed line over here, okay? So eventually A will move back to this point on the IRP. Now we can do the same analysis for B as well, and through that analysis, we will see that eventually things will go back to equilibrium and B will move back here, okay? All right, so next we'll talk about uncovered arbitrage, uncovered IRP. So what we talked about before was we were linking the interest rates and the forward and the spot rates, okay? So in this case, this is a covered IRP or this is a covered interest arbitrage, okay? So by covered, we say that the foreign exchange rate risk has been taken care of by the forward contract, okay? Now, if we recall from derivatives, we say that the forward rate is set as the future expectation of investors, okay? So the forward rate reflects the investor's expectation about the future value of the currency, okay? So for example, in this case, my forward rate would be investors' expectations about the value of the pound in 1 year's time. Okay. So here we can write the forward rate as the conditional expectation about the future spot rate. So about the future value of the pounds, condition on the information that we currently have. Okay. So if the right-hand side is our conditional expectation for the future spot rate, condition on our information set as of today. Okay. So in this case, we can write the IRP as, we just replace the forward rate with the expectation. Okay. So in this case, the IRP could be rewritten as here. So this is an uncovered IRB in the sense that here our exchange rate, we allow for exchange rate to move in the future. Okay. So here we are set the IRP with the expectation about the future. Okay. So this term is not certain. The future, in the future, the exchange rate or the value of the pounds could change, right? If we have a different expectation. Okay. All right. So to summarize, with covered IRP, we're talking about interest rates, current spot rate, and future and forward rate. Okay. With uncovered IRP, we are not talking about locking in a rate. We are talking about just the future expectation. Okay. So this term can change, and as a result, this is uncovered. Okay. All right. So we have said before that the IRP should hold, otherwise there would be arbitrage. And finally, the arbitrage, the arbitrage activities will bring the IRP back to equilibrium, right? But in real life, sometimes there could be discrepancies between the actual IRP, the theoretical IRP rate, and the actual forward rate, for example. Okay. So in this case, we could explain the discrepancy between the actual IRP forward rate and the actual forward rate and the IRP forward rate by different transaction costs. Okay. So for example, in our calculation before, we assume that everyone in the US could be borrowing and lending at the same rate, okay, which is the interest rate in the US. Similarly, for the UK, we assume that everyone can lend and borrow at the same rate in the UK, okay. As a result, we can switch the direction easily without having to change our rate, okay. In addition to that, there could be bid and ask spreads, okay? So as we mentioned before, with the forward and spot exchange rate market, people quote bid and ask rates, okay? So as a result, when you take into account bid and ask spread, your forward, your IRP could be a little bit different, okay? The second reason is for IRP to hold, we need people to arbitrage, okay? So whenever the equilibrium is not met, people will arbitrage away. So for arbitrage to happen, you need a free market where people can exchange capital easily. So in this case, if you have a government that imposes capital controls, it will create a discrepancy between the IRP rate and the actual rate, okay? So having said that, having talked about different reasons why the IRP does not hold, now because of these reasons, we need to allow for a range within which the IRP should be considered to be hold. So in this case, if I modify the IRP line from just a line to a range, I can determine that within this range, because of transaction costs, so on and so forth, these issues make the IRP does not hold, but this is not a profitable arbitrage condition. Okay, So when you are here, when you're on this point here, this is when, even though it's not the IRP level, but you cannot arbitrage this away because of transaction costs, and it will just stay here. Okay, so there will be no further adjustment. Now, when you stay here, when you stay on this point here, which is C, this is when your discrepancy is explained by two things. The first thing is transaction costs, which you cannot arbitrage away. And the second thing is an actual profitable arbitrage opportunity. Okay, so in this case, you can arbitrage, and through your arbitrage activity, you will move down to this point here. Okay. So in terms of empirical evidence, in the past, people have tried to look at the data to see if the IRP actually holds in practice. Okay. So one example here is a study in Japan, and what they did was they computed the deviation from the IRP. Okay. So what they did was they rearranged the IRP equation so that it will go to the right-hand side. Okay. So if the IRP holds, then this discrepancy here should be 0. Okay. So if the IRP holds strictly, then this equation should be 0. If we take into account different statistical discrepancies, then the deviation from the IRP should be randomly distributed around a mean of 0. Okay, meaning that it's statistically not different from 0. So when people plotted the deviation from the IRP on the plot and they compare that with the actual data, they find that in Japan, in the period before the 1980s, there has been a great discrepancy. Okay, so the interest rate actually deviates from the IRP conditions. Okay. After the 1980s, it seems that the IRP holds. Okay. So one reason for this could be that the Japanese government has been trying to depreciate the yen so that they can export more. Okay. So after the 1980s, it seems that they liberalized their foreign exchange market. So they let the market forces determine the exchange rates. And as a result, there's no restrictions on capital controls. Okay. So as a result, the discrepancy starts to disappear over time. Okay. So in this lecture, we have talked about the interest rate parity condition, which is the relationship between interest rates and foreign exchange rates. Okay. So here we talk about the covered interest rate conditions in the sense that we involve the forward exchange rate market. Okay. We have also talked about the uncovered IRP, which is when we don't lock in the rate at the forward contract, but we condition the IRP on the expectation about the future. Okay. We also use arbitrage to prove the IRP. So in this case, when we talk about arbitrage and interest rates, we're talking about borrowing and lending. Okay. So here we said that whenever it's cheaper for us to borrow from the domestic market, we will be borrowing from the domestic market and lend to the foreign market. Okay. In contrast, whenever it's cheaper for us to borrow domestic, so in the previous example, this is when it's more expensive to borrow in the domestic market. So I'll be lending to the domestic market and I'll be borrowing from the foreign market. Okay. In the second case, this is when it's cheaper for me to borrow domestic, and at the same time, I'll be lending to the foreign market. Okay. So through these arbitrage activities, the mispricing should disappear, and eventually the IRP should go back to equilibrium. Okay. So through our discussion today, we have talked about these issues. For next week, we will talk about different other interest rate parity conditions. So different other international parity conditions, but by far this is the most important parity condition. Okay. All right. So for next week, we will have a break for a week starting from Friday. And during the break, your assignment will be due on Wednesday, okay, at midnight. I will be having a consultation tomorrow from 11 to 1, and you're welcome to ask me any questions about the assignment tomorrow, okay? Now, you could also check the LMS and you'll see that I have uploaded a frequently asked question about the assignment. So read that document first before you want to ask me anything, okay? So other than that, is there any other questions or comments before we conclude? If not, I will conclude the class for now. Have a good evening. Yes.
I have logged into the consultation today with the teachers, but there is nothing appears after that.
What does that mean? So you couldn't see the teacher or?
Yeah, when I go to the link, it doesn't appears anything in today.
Oh, okay. All right. I'll check the link again. Thanks for letting me know. So I'll check the link for tomorrow again. I'll be there during that period anyway. So if you can't see me, just drop me an email, and I will send you the direct link. Okay.
Yeah. Thank you.
Okay. No worries. Any more questions? If not, have a good evening, guys, and I will see some of you tomorrow. Okay. Otherwise, have a good break, and I'll see you back after 1 week. Bye for now, guys.